So again, net PP&E is going to be kind of a tricky thing here. We're going to forecast it out as a function of revenue because we do assume that in general, our requirements for fixed assets are going to increase with or decrease with revenue. But if I sell tons more product, I'm going to need more machinery, more manufacturing space, factory space. I'm going to need more space to house all my employees. I'm going to need more delivery trucks, et cetera, et cetera, et cetera. Right? What is difficult is that revenue typically grows at a pretty even pace. In other words, I'll forecast revenue growth at 10% per year. And while that's a pretty reasonable assumption for revenue, it isn't a very reasonable assumption for PP&E because we don't buy fixed assets in portions. I don't buy 20% of the machine I need. I buy it all at once. And then I use the machine and I ramp up production until that machine is tapped out, and then I buy another one. Right? And so forecasting PP&E as a function of revenue is going to bring a little bit of unrealistic distortion to the balance sheet because it's going to assume a steady growth in fixed assets that isn't the way that an actual firm would behave. The problem is that it's just hard to do that in any other way. So it's hard to say estimate the capacity for a new factory and then when that factory would reach capacity and then how much a new one would cost 5 years down the road. It's just easier to recognize it's unrealistic but forecast it as a percentage of revenue anyway. Okay. Then we got some sort of our non-operating line items like non-operating assets. We're not going to assume that there is any forecast driver for non-operating assets because remember the firm isn't in the business of having non-operating assets. It might have some equity investments that it makes. It might have, again, an old building that it's leasing out to a different company, but it's not going to be growing those with any regularity or intention because that's not what the firm's operations are about. Now, if that changes, then that changes, but we're not going to forecast any growth here specifically unless we know that there's a growth rate involved there. Certainly we won't forecast it as a function of any other financial item. Pensions, assets and liabilities, remember this is money that we owe our pension plan or money that our pension plan has generated on top of what it needs. And we are just going to assume those kind of things trend towards zero. Again, the firm shouldn't be in the business of having excess money in the pension or too little money in the pension, although too little money, again, is the norm in the US and most of the developed world. But we're going to assume that those extraneous items trend towards zero. Deferred taxes here are going to be a function of the operating tax or the corresponding balance sheet item that generates those deferred taxes. And so we will do those as a function of that. It's a little more complicated forecasting that kind of thing. And we can talk about it in more detail if the need arises. So here's some examples of forecasting the balance sheet. Forecasting working cash as a percentage of revenue, PP&E as a percentage of revenue, and again, way more examples in the example problem where we actually do the whole process. Now, to complete the balance sheet, and again, you'll see this happen in the example, we need to forecast the company's sources of financing, and that means that we need to make sure that we forecast the statement of retained earnings. And the statement of retained earnings is an accounting statement that says that retained earnings in next year equal retained earnings this year plus your net income minus your dividends. Because remember, net income gets divided into dividends and retained earnings. Right? So any profit the firm generates is either paid out to its equity holders as their share, that's a dividend, or it's taken into retained earnings and it's put into the firm's savings account. Right? So retained earnings is an item on the balance sheet. It's an item in the owner's equity and liability side where this is what the firm is saving for making investments with capital that's already inside the firm. So one of the things that we need to make sure when we're doing this is that we are correctly flowing our net income from our forecasted income statement into the balance sheet and that the balance sheet is still balancing after that. So we're going to forecast net income we'll forecast all the other items on the income statement, calculate net income as a result of those forecasts. Then we'll think about the dividend payout policy of the firm. And again, this should be established. If the firm is paying a dividend, it's probably paying an established dividend payout policy. Maybe it's 20%, maybe it's 30%. We're going to look at the historical payout policy. Then we'll calculate the dividends that the firm is going to pay on this new forecasted year of net income. Anything left over will be put back into retained earnings, and retained earnings there will be reconciled to the balance sheet. So what you would see is in that forecasted year down at the bottom, ending retained earnings, 113.8 million, that's going to be the forecasted retained earnings line item on the balance sheet. All right, so we're plugging that into the balance sheet. Now what might happen here is that this, if the firm has too much profit, this is going to unbalance the balance sheet. And so now we want to talk about what happens when the balance sheet, the forecasted balance sheet, doesn't balance anymore. Either because we have too much retained earnings, so the firm's savings account has grown, or we didn't have any retained earnings, and so the firm has had assets grow more than its liabilities and owner's equity, and so the firm needs new capital to satisfy the balance sheet. Right? Remember that the balance sheet balancing is an accounting measure, but it does so because of economics. Right? The balance sheet must balance. The assets must have been paid for by the liabilities or equity, the financing from the liabilities or owner's equity. And if there's excess financing, then that has to go either back to the shareholders as dividends, or it has to go into the asset side. If you have extra cash, you need to put it into the firm's savings account. This is what balances the balance sheet are two items, new items on the balance sheet that we add that are called the plug. So the plug on the asset side is what we call excess cash. If the financing side of the balance sheet, owner's equity and liabilities, has increased in value more than assets have increased in value, then the unbalanced part will be that liabilities and owner's equity exceed assets. But that doesn't make any sense. The firm doesn't have more financing than it has assets. That excess financing gets put into a savings account, and the savings account on the asset side is the cash balance. So we raise the cash balance by the difference, and then the balance sheet will balance. So the plug is the excess cash that we put into the cash account. If it's the flip side, if our assets have been forecasted to grow faster than our liabilities and owner's equity, the only way that can happen is if the firm raises new financing to pay for these new assets. And so on the financing side, owner's equity and liabilities, we plug with an item called newly issued debt. And this is a simple model. We are just here going to assume that the firm raises all new financing with debt. Unless things get really out of whack, then we would talk about how firms would raise equity as a way to raise financing here. But in general, we ignore equity again because equity is much more difficult to raise than debt. Equity offerings are more significant, and we'll talk about equity and debt in more detail in their own chapters. Then we'll go more into that. But in a simple model, we just assume the plug is either going to be financing coming from new debt or excess financing going into an excess cash account. Okay? And so you'll see the example of how we do the plug. We're just going to see which side of the balance sheet is larger, and then we'll plug into the requisite account there, either excess cash if assets are less than liabilities, or into newly issued debt if assets are greater than liabilities. And again, as I mentioned in the video for the Excel example, this is some extra credit on homework 4. If you can automate this plug process without having to calculate this manually, so that if I change some numbers, it will automatically recalculate your plug, I'll give you some extra credit. Not a super hard Excel example, but a little bit higher level than what you've been required to do so far. So challenge yourself a little bit if you got some free time. If not, this is one thing that you can hard code. Then we take all our forecasted information, and these are really small, I know it's kind of hard to see. So we've used our historical data to calculate our forecasts. Then we've reorganized our forecasted and historical data to calculate NOPLAT and invested capital. We've used that then to calculate free cash flow, both on a historical and a forecasted basis in all of our years. So here I'm only displaying 3 years of historical data, 3 years of forecasted data, but of course in practice we would have 10 and 15. But I'm in goal calculating free cash flows so that I can then take the present values of the free cash flows, add them all together, get enterprise value. That's the value of the firm. Right? We got a couple of issues here, and some of them I've already talked about, so I won't spend a lot of time. we are definitely going to want to look at non-financial operating drivers. In other words, when we do our detailed forecast, go as deep into the details as you can. Look at things like volume, look at things like productivity. If you're an airline, look at items like available seat miles. If you're FedEx, you're looking at efficient driving metrics and things like that as a way to help build your forecast into more reliable predictions about the future. If we're thinking about fixed versus variable costs, that's not really that important for a big firm because ultimately all costs are going to be variable at that level. But if we're doing an analysis on like an individual project or retail stores, then most of their costs are going to be fixed instead of variable. They're just paying for the lights and the location and the employees. And so then we do need to think about that. But in general, for corporate level studies, we don't. We should account for inflation, but if we don't, if we haven't included inflation when we're talking about the cost of capital, if we're using nominal terms instead of real terms, then our forecast should agree with that. And this is a little more complicated of an issue. It's not a huge deal unless you mistake whether you're using nominal or real. But it should be pretty obvious on the face of it which one you're using. And so that's all I got. Forecasting is hugely important. Again, this is the foundation of the analysis because we're forecasting the future cash flows, and that's what we value. You'll see this in the Excel example that's posted, and you'll see it again in homework 4, which is all about forecasting. So again, hope you guys are doing well. I hope these lectures are making sense, and I hope they're helping. And again, if you have any questions, please let me know, and we'll see you next week.